Yeah. Hello, it's Rhonda Thomas, and we are working on managerial accounting, specifically Chapter 6. We are getting ready to do Chapter 6's coursework, and I did not get the very first problem videoed in this video, so we're going to do problems 2, 3, 4, 5 in Cengage. To finish out the coursework, you should find the intro exercises already have a video out there. And then, yes, I will make a video for just the very first problem, because the very first problem we did was another high-low method, and it's good to practice that, okay? So now that we're in cost, volume, profit analysis, let's understand things about this. So, this says contribution margin and contribution margin ratio. We've got McDonald's here. Okay, now I have not put anything in about this, but I have an idea of what it's like. So this is McDonald's numbers, and please know that this is in the millions, okay? No, McDonald's is making more than $21,000 a year, okay? So this is in millions. So they've just taken off the last 3 zeros, so the accountants don't have to key in zeros all the time. Okay, here's what you need to know. Here's something I'd like you to memorize or have ready in your head. Okay, once again, it's sales minus variable costs. Contribution margin is what you get when you subtract those, and then we subtract those fixed costs. Okay. Then we get something called operating income. By the way, I took this class from Professor Akal back in 1997 or whatever it was, and she made us learn this, okay? So I thought that was worth doing, all right? So I don't know anything about the units sold yet, okay? We're gonna do a little work here, and then we're gonna put it into some information that we are going to find. So here's the sales, food and paper, payroll, and employee benefits. Okay, so if you give me just a second, I'm going to key this stuff in. Okay, so have at it. Make sure you do this too. Okay, so I'm just going to follow along here. And, okay, food and paper. You can abbreviate if you want. Okay, so I'm going to put these in as negatives so that you know these are costs, right? You know these are costs. Food and paper, payroll. Okay, I'm just going to put payroll. Okay, and that is 2,200. And then occupancy. Okay, is a negative 4,300. And general, selling, and admin. Okay, so put those in, okay, somewhere. Now we want to add up that what you just put in comes to the cost total that you see right there, right? So this is the cost total, even though they didn't label it. So I just want the costs. I don't want to include the sales. I just want the costs. Okay, so we know what they are. Okay, so total costs are 12,000, which matches what that says. Okay, never take for granted that you entered something in right. There's always a chance. So now we want operating income. Okay, operating income happens when you subtract the total costs from the sales. Okay, so you could go ahead and do that if you want, or no, you can see it. Now we're going to turn it into more of a variable cost, fixed cost example. All right, so the operating income, without breaking it down into variable and fixed, okay, is indeed the $9,000. And please remember that's McDonald's in millions. I would guess it might even be billions. I don't know. Doesn't seem like millions would be enough. Okay, operating income is pretty much the bottom line right now in this accounting class. So you take your sales and subtract your total costs. And there's the 9,000. Okay, so that information's ready to go now. All right, so now let's read the rest of this. Now we're going to break it up into variable costs and fixed costs. Okay, so it's telling us that the variable costs consist of food and paper. So let's just go right next to this column that we have here, right? Let's put variable cost at the top. Just variable is fine. Variable and fixed. So if it's a variable, we're going to put it under the variable column. If it's a fixed, we'll put it under fixed, and some have a combination of both. Okay, so we're going to put it on under whichever whether it tells us to. Okay, all right, so we're looking at costs only. Okay, don't try to do a sale because that's revenue, that's incoming. Food and paper, they say, is completely variable. Do you believe that? Food and paper at McDonald's. Is it completely variable? Sure it is, because it matters how many hamburgers they wrapped up, how many French fries they're serving, right? So every time food leaves McDonald's, there goes some variable cost. Okay, so yep, they said that food and paper is definitely a variable cost. They also said that payroll is too. Okay, so it's up to them how they want to break it up. So far we've got two things under the variable column. Okay, occupancy. Now occupancy goes 25% to variable, leaving 75% to what? Fixed. Okay. All right, so what I'm going to do is I'm going to put equals 0.25 times the amount we have for occupancy. I think occupancy is probably the rent of the place that the McDonald's is in. Now, right next door to it, I'm going to put I haven't done the last one. Now let's go down to the general selling and admin. Okay, and it says that 40% of the general selling and admin are actually variable costs. So we're going to do the same thing. And by the way, I'm going to put that right here just in case we forget. Just in case we forget, I'm going to put 25% to 75%. Okay, that was in occupancy. That way, if anybody ever asks, how'd you get that number, then I'll remember what I did. Okay, so, and then the general selling and admin, 40% goes to variable, leaving us with 60% goes to fixed. You see that? I put that in my spreadsheet. So when you look at this is 25% of this. So then this has to be 75%. You can do a subtraction if that's what you want, or you can do the math, or you can do the multiplication. I'm just going to do the subtraction. So I'm just going to take this full number for occupancy, take out 25%, and the remainder goes under fixed. Okay, let's do that for the general selling and admin. The first variable gets 40% of 2,700. Okay, so we're going to do the math here. So we'll take this number times 0.4 or 40%. I like to usually use decimals when I'm doing my math. Okay, so there's 40% of it. Now we can find the remainder goes to fixed. Okay, so this is breaking some of this out. And before you go any further, once you've got your two columns going, you should have four numbers for your variable costs. That should add up to a certain amount. And then you should have both occupancy and general selling and admin for fixed. And we're going to add up that amount. Okay, so let's add these up. Okay. So our variable expenses, mine is 7,155. And then my two fixed expenses added together, come on, is 4,845. Is there a check figure to this? Anybody know? Guess what it's supposed to add up to? The full amount of your expenses, right? So if you just, I'm kind of one of those warm and fuzzy people when I got to check something. Give me a check figure so I have something. That's not what I want. I want to add those two together, right? That way we know whether we didn't go key in another number that we shouldn't. Everybody see this? So this is great. We've broken up all these expenses here. So this number is variable and this number is fixed. Now we're going to do a contribution margin. Okay, now we're ready to do a contribution margin. Okay, sometimes all you have is total amounts. We don't have how much every item is. So in this case, I don't even think they give us any indication of what the volume is. Okay, so over here in my total column, under sales, okay, I'm going to put 21,000. Okay, 21,000. Okay, then I'm going to make total variable costs equal what I found in this column right here. Okay, which gives me a contribution margin of, and I got to change the sign there so that it doesn't, make sure you follow your calculations through so you don't mess up. Okay. And their fixed costs. How much are their fixed costs? I think they're these two added together, if I understand things right. So I'm going to make it equal that. So it looks like we have operating income. So here's what I think you should have. It says, what is McDonald's contribution margin? Round to the nearest tenth of a million. Okay. So the margin itself, that's the total amount. Okay. I'm going to tell you right now, this gets real confusing if you're not focusing on the words. Over here in this total column is representing this. Everybody got that? So when they ask for the amount of the contribution margin, they want to know the whole thing. If we would have gotten some kind of volume of this food, then we could have gotten it by the unit. But they did not indicate at all anything about the volume, right? So here is the sales, subtracting the variable cost we found. Here's your contribution margin. That should be the number for that answer. Okay, it's the contribution margin in total. I wish they would use the word total every time. So now let me see if this is right. I hope it is. Makes most sense to, okay, let me see what I did. Let me see here. What is McDonald's, okay, contribution margin? Let's jump down to, okay, one decimal place. That's probably what's wrong. Let me go put in the decimals here, guys, I guess. Well, okay. 18,690. Okay. And I got, I'm gonna make sure I keyed in everything right. 28, 22, 43, 27. Yes. And operating income is 9. Okay. So the contribution margin, round to the nearest tenth of a million, one decimal place. Okay. Okay. Say, I've got the contribution margin ratio of 66%. Let me see if I've got that right. Lord only knows. Nope, I guess I don't. Okay, I will see what I got here. Let me see. Golly, I thought that would make sense, but apparently it doesn't. Okay, what is the contribution margin? Round to the nearest tenth of a million. Okay, so they have their sales minus oh, hold on. Okay, so okay, no, that's all of them. So it's showing total variable costs, contribution margin. That's what I got. Okay. And then there's, well, I guess I should have tested it out because here I am again with, okay, so let me see. So this one, I'm going to calculate the one I have here. In fact, I'm going to do it on the board. Okay. Those of you who are listening, I read this thinking it wasn't going to be too bad, and I must have missed something. So once again, I'm going to go with my sales. Okay. So let me do this problem that I have as an example. All right. In this one, sales are 19,000. I'm going to see if I can find where I went wrong. Food and paper is 2,800. Payroll is 2,100. Okay. Occupancy and other expenses is the 45. And then general selling and admin. Okay, it's 46. And they did the math for us. So the total costs are 14,000. And then the income is 5,000. So 14,000 from 19,000. Yeah, it makes sense. So here's operating income. Okay, so now let's break this out into variable. They said this is all variable. So variable costs, fixed costs. Like I said, I'm just doing it again. All right, so I'm going to move this one over. 2,800 goes there and 2,100 goes under variable. Okay. Oh, all right. And then this problem says that 25%, is that right? 25%. Yeah, I think we have all got 25% of occupancy and other expenses and 40% of the general. All right. So this one gets, here's the percentages to use. So 25%, which leaves 75% fixed. And then 40% to 60%. Okay, so I'm going to take 25% of this and put it here. 75% of it goes here. Okay, 28. So 4,500 times 0.25. I got 1,125, and then put the rest here under fixed. So I'm just doing it again to try to see what is happening. All right, so the rest of it goes to fixed. And then the same goes here. 40% of this goes to variable, and then 60% of it goes to fixed. So 4,600 times 0.4, I got 1,840. Okay, and then the 60. So 4,600 minus 1,840. Okay, I got 2,006. All right. So then we would want to add these together for the amount of variable costs, add these together for the fixed costs. So let's see if that's what they did. Okay. Okay, let's start. I broke it up too quickly. Let's use this, okay? So here's what I want you to do. This is actually the contribution margin. Oh, that's contribution margin, not operating income. That's my fault. Okay, wait a minute. That is not, okay. That is, no, that says contribution, no. Okay. All right. So if we took our sales, 19,000 and subtract these here, we should get variable costs. Sales, variable cost equals contribution margin, and then we'll have fixed costs. Okay, so let's take 19,000. I'm going to add these four together. I don't know why it didn't work. Okay. All right, let's add it together. So 2,800 plus 2,100 plus 1,840. Okay, I got 7,865. That should be subtracted to get our contribution margin. Okay, so we're going to subtract that and see if I come up with the right figure. Okay. Total variable costs. Yes, that's the number, and you subtract it. Okay, so I'm going to see what I did wrong here. Let me finish this one out. So 19,000 minus 7,865 gives us a contribution margin of 11,135. Now we subtract the fixed. Okay, so we add these two together. Plus 2,760. This is 6,135. Both of these added together needs to be sure to equal 14,000. So there's the check figure to make sure we did. So then this is fixed. Okay, so if you put fixed in here, 6,135. Okay, then there's where we get $5,000 worth of what? Operating income. Yep. And the operating income should be the same at the bottom, and that is what's happening. Okay, and so then to get the contribution margin ratio, you take this divided by sales. So we know what percentage this is of sales. So 11,135 divided by 19,000 is, okay, so 0.586 is what I'm going to put. Okay, do they tell you? Yeah, round, round to the nearest 1/10 of a million, 1 decimal place. Okay, so that should be 59, so 59%. And then that makes variable costs. Just subtract 59. Okay, so that makes this 41. 41% here, 59% here. Here's your 100%. Okay, so now let me see what I did here. I still don't. Maybe I just keyed in something wrong. So I don't think so though. Variable 43, 27, 12. My only fear is if the problem is calculating correctly or not. So
what did you get for your total variable?
Total variable is this one, right? So the first two are all variable. 25% of variable occupancy, 75% fixed.
And what was your total on that one? I can't see.
Okay,
It's a 7,000.
this is the variable total. Yes, there's the variable total. I got 71.55. And like I said, I'm not looking at the key. I'm actually doing a problem.
Well, I was gonna say, I went through this one a bunch of times on mine too, and I finally got that one to be right by just taking the 21,000 minus that 7,000.
Okay. Okay. Well, and I thought that's what I've done here, right? So here I've got variable costs.
It doesn't want you to take that fixed cost out though.
Okay, okay, I see. Well, but then fixed costs are down here. So I'm, yeah. That's interesting. Cause I can see on their problem, let me just try it. All right, let me just try this. Okay, so if we took the whole, you just took all of the costs?
Like that,
Just
that
that 13.
7,000, like that 13 or whatever, the
Yeah, the
conference margin, put that
13,845.
one in your A and C, if that, because I struggled on that one too.
The contribution margin, oh. There it is. Guess what? I was putting in something different. Okay, all right. So, okay. So let me put 13,845. Let's see. Hey, cool. All right, now we're back in business. I must have grabbed the wrong number. So that makes my contribution margin ratio, that's always going to be a percentage. Okay, this contribution margin ratio, let me check it. So equals the amount that's going to contribute contribution margin divided by the sales. Okay, is 66%, but let me extend these out a little bit to see if we have probably a decimal here. Sorry about that. Okay, 1 decimal place. All right, so let's try this. How about 65.9? Okay, 65.9. And hopefully that's what they want. It is. So the next question is, how much would operating income increase if same store sales increased by $1 million for the coming year? Here's what you don't know, or you may not know. This is operating leverage. This is what they call operating leverage, even though they're not telling you that. So if the sales increased, all right, so let me show you what I mean. If sales are going to go up $1 million, all right, so let's just put this down. Sales increases $1 million. When you learn how to use operating leverage, you actually know the impact of that increase in sales. Okay, so it was increased by $1 million, 1 million. Okay, for the coming year with no change in the contribution margin or fixed costs. Round your answer to the nearest tenth of $1 million. So how much will the operating income go up? Okay, so leverage, we haven't done a leverage yet, but back on your intro problems, how you do leverage is you take your contribution margin as your numerator. So I'm going to write this on the board. Okay, operating leverage. Okay, you take your contribution margin in dollars, total dollars, you're going to divide by your operating income. Operating income. So contribution margin is what we just found in A, right? And we're going to take all right, so we're going to find our leverage and put that in. Okay, so sales are up 1 million, so an increase. And by the way, leverage works both ways. If you have a lot of leverage, if you if sales increase, then that is going to amplify the increase. But if you have a loss, it will also amplify the loss. So put down operating leverage and go find the amount for your contribution margin. Mine is 13,845. And then, okay, and then I need to do my math correctly here. So that is a plus. Okay, so my operating income should be my contribution margin minus the fixed costs. Okay, so let me get that put in. And so 9,000, and it agrees, right? By the way, operating income should be the same, no matter what method we used to put together the income statement. So now I'm going to take 13,845 as my contribution margin. Okay, and this is in dollars. Okay, in fact, I'm going to put total contribution margin because sometimes they want it unit contribution margin, and that can be challenging. All right, so here's my numerator and here's my denominator. All right, so my denominator is 9,000. And then when we find out what the leverage is, you're going to take contribution margin divided by your operating income to find this operating leverage. Okay, and then we're going to take that times the amount of the increase. Okay, so my operating leverage is 1.53833. All right. And then, so there's your operating leverage, whatever you got for that. Let's take it down to, let's take it down a little bit from that many decimals. Nope. Okay, so let's go with 2 decimals. We're going to take that and we're going to take that times the $1 million increase. Okay, whatever your operating leverage ends up being, when you multiply that times how much your sales changed, that is how much your operating income will change. Okay, so one more time. If sales is up $1 million, okay, so if you put $1 million here and you go find that leverage, then you can calculate how much operating income will be. All right, so I'm putting in the $1 million increase. So here's sales increase. And you got to use just the increase, not what the new total is, just the increase. Now you use that operating leverage. You're going to take 1 million times 1 point, whatever you got, whatever your leverage is. So the more leveraged you are as a business, the more sensitive your operating income is to a change in sales. Okay, if you're not leveraged very much, then it doesn't hurt so bad. So now let me put this in. So it's times $1 million, right? And that will get you your operating income. Okay, and then they say round your answer to the nearest 10th of a million. Okay, 10th of a million. So I'm going to bring it back down. Okay, I'm just going to make it 1.5. All right, so I should have in operating income, that's what this is. Operating income, I have 1,538,333.3. Okay, well, that's how it's supposed to work. All right, so I'm gonna put this in. See if I got it. 0.3. Okay. All right. It's just, I guess it's just not meant for me today. Okay, 800 million. So they just, oh, they're just putting it in millions. Okay, got it. I put all the decimals in. Got it.
Yeah.
Okay, yeah. So it's 1.5 3 8 1.4, I think. Or they said they want this rounded up to 1 decimal place. Let's see. Okay. So,
Is that 1,000 or? Yeah.
well, my leverage ended up being 1.5 and 3, or I just don't know what, they didn't tell me how they wanted me to, what's the contribution margin?
Is it
Okay,
increased by 1,000 or 31,000? What is it?
no, this was what your operating income is to be. The increase is 1 million, right?
Okay.
1 million, so I'll just put 1M there.
I had like
Huh?
a similar deal and I was like, I did the way you did.
Yeah,
And
and didn't work out.
I ended up just moving the decimal of my contribution margin ratio. It
Oh,
was just 659.0. And that's the
Yeah, me
answer
too.
that they want. I don't know.
Okay.
I didn't
the
understand.
65.9.
Yeah,
Yeah.
it was just move that decimal over. to the
Over?
right one.
Okay,
I don't know.
that's okay. No, I'm trying to, like I said, you're supposed to be able to find the leverage and then take it times the change. Okay, so let me see here. You said 6.59? No.
659.
659. Got it. Wow, I'm impressed.
I didn't understand why.
Well, I don't like that. I don't understand for a moment either, but you're gonna see operating leverage works like that, but maybe they're doing it different. Okay, that's fine. Thank you. I'm glad you experimented to figure it out. Yeah. I'm sorry that like I said, I just looked at these thinking, oh, these aren't gonna be too bad. Then I didn't follow through with doing it. All right. One more time, how much would and it's operating income increase. So, okay, so 800 million and then you, and then you use your contribution margin. So that's why they told you to use this to 1 decimal place. Okay, 1 decimal place. So very good. Onward we go. Okay. The third one, hopefully, is break even, right? So let's remember, break even means we have operating income is 0, right? Break even. All right, so I'm going to use this little. Okay, so it says currently the unit selling price. Now, sometimes that's all you get is a unit selling price. Maybe you don't know how many units it is. So you got to find the formula that works. Okay, so this time they're saying that the unit selling price is $350 each. Okay, unit selling price is 350, and then the variable cost is 290. And that leaves, and the fixed costs are 960,000. Okay, so I'm feeding this in here. Okay, so I've got a couple formulas here, but I want to explain this. All right, so it says compute the current break-even sales in units. So how many units is it going to take for this to be true? Okay, so what I did was for break even in sales, you take your fixed costs. Okay, so my fixed costs are 960,000. So I'm going to put that in, and then I'm going to divide by the unit contribution margin of $60 a piece. Okay, so let me put this in and see what it ends up doing. Okay, so 960 is my fixed, and I'm going to divide by 60. Okay, so then let me make sure that this is the case. Yes. Okay, I got it figured, but I wanted to figure it again to make sure it's right. So before they start doing any changes, break even right now is 16,000 units of whatever we're making. Okay, so once you know how much a sales price is, if you know either one of these, you can find the other. Okay, and then you know what your fixed cost is. You won't hardly ever see fixed cost by a unit. So the break even amount of units is 16,000. Okay, and now they want to add a little bit to it. This is called the target. Okay, so there's that. So are you in business just to break even every day? No. Hopefully you'll have more later, right? So, well, let's plan on more. What would that take, right? It says they want an extra, the selling price changed. That's all it changed. Change your selling price to see if you have a higher selling price, then your number of units should go down. How many you need to break even, right? Yep. So my selling price went up by $40. Correct? Yep. Went up by $40. Look, a $40 sales price. And with that, we're hanging on to quite a bit more of our contribution margin, $40 more. And so we'll only need 9,600 is the break even units with that new price. Okay. So 9,600 units. And you can always plug this in to make it be true or not. Okay, so you say, what? How did you do that? Let me show you. I like plugging it into an income statement where it shows 0, right? So just for kicks, I'm going to put 9,600 is the number of units. So 9,600, okay. And I'm going to take that times 390, which is my new sales price. So the sales price went up, but it didn't say anything about the variable costs going up, but the variable costs will go up. So we're going to put 9,600 here as well. Okay, so I got to do the new math to this. 9,600 times the variable cost. Okay, so then let's see, we're just testing this out, equals this minus this. Okay, so there it is. Okay, so yep, we're still at 0. So that worked both places. Okay, here comes classifying costs. Have you made it through? Some of you already? Okay, so this is just saying, is it variable? Is it fixed? Is it both? Okay, so if you want to holler out, how about shipping boxes for shipping orders? Variable, yes. Okay. Consulting fee of 200,000 paid to a specialist for marketing advice. Fixed. Yep. Doesn't matter how many we're doing. Okay. Straight line depreciation. Immediately when you see depreciation or the word possibly salary, okay, depreciation is always going to be fixed. Here's one that got a little bit. So if you see the word salary, salary is usually fixed, but it's got an extra to it. So I would say this one's mixed. Okay, let's see if I'm right. Okay, so far so good. We are making clothing. So fabric is going to be direct materials, right? Sure. Fabric, dye, thread, that's all going into the product. So those are all variables because their volume will change when we sell or produce more. How about the salary of the designers? Now there is no extra piece to that. So that should be fixed. Okay, brass buttons, I assume that goes on the close, so we're gonna say variable. Legal fees paid to an attorney in defense of the company in a patent infringement lawsuit. Here's the fixed part, here's the variable part. So J should be variable. Okay? Oh, it isn't? Why not? Paid legal fees. Paid legal fees. In defense of the company in a patent infringement suit.
Is it because there's a fixed cost per hour?
But
So.
their bill is gonna differ. I'll just put mixed. Isn't that what I said? They say it's fixed instead of, is that right?
they had
No.
Variable at first.
Oh, I picked the wrong one. Okay, I wanted mixed. Maybe I just picked it wrong. There it is. Okay, insurance premiums. Insurance premiums. Insurance is usually fixed plus, so plus $5 per 30,000, that should be mixed also. So if they've got a combination, rental costs of warehouse, there's a base rental plus $4 per square foot. Yep. Mixed. Supplies, I would say is variable. Let's see if I'm right. They don't give a certain amount. Okay. Leather for the patches on the brand. I'm going to say that's a variable. Rent on the plant is fixed. Salary is fixed without any extra. Wages. Here's the janitor, right? The janitor services, 2,200 per month. I believe that's fixed. Let's see. Yep. Sometimes if it goes in overhead, okay? Sometimes if it's not a direct material or a direct labor, a lot of times it's going to be fixed. Wages of those machine operators, that's definitely going to vary based on the volume. Last two, electricity costs of 10 cents a kilowatt hour. That's completely variable. And then property tax, that's completely fixed. Very good. All right, last one. Have you started on this? Or you got it done?
We started.
Okay,
Yeah.
that's, nope, that's okay. I haven't taken a look, but I'm just about to. So looks to me like maintain the same inventories at the end of year 3 as the beginning of the year. The total of all production costs for the year is therefore assumed to be equal to the cost of goods sold. With this in mind, the various department heads were asked to submit estimates of the costs for their departments during the year. A summary report of the estimates are below. So once again, these are all estimates. Here are our unit costs right here. Okay. It looks to me like, okay, it's expected, and here's your price, by the way, of the unit. Notice it's down here in the darn paragraph. Yep. All right, so we need to do a little math and put together an income statement. Well, we know that sales get started at the top. And what was it they said about cost of goods sold? The total of all the production costs. So that's going to be these 3 times the number of units. So there's the units, 21,875. So you're going to take that times. All right. So I'm just going to go down here to the bottom. Okay. So sales and the amount that they sold, okay, in units is the 20, I got 21,875. Okay. And then we're going to take that times the cost. Okay. Sales price is 160. Okay. 160. Let's keep this as units and that is dollars. Well, I know we're almost time to go. So I'll tell you what, so I don't get you caught off guard. I'm going to just keep going, but I'm going to go ahead and finish this on the video so that you can see the rest of it if you need to go. But now we need to put in per unit, right? Per unit. And then the total is here. So this should tell you how many we sold times its price. Okay, so price per unit, sales price per unit. Yeah, I'm just put per unit. Okay, so let's see. $660. What happened? Okay. All right. If you need to go, go, but we need to assemble this just like we would any other. We're just going to change the way it looks because we're going to do variable costs, right? This is just an income statement based on the things that we knew before we started breaking it up into variable and fixed. So then we're going to have to figure out what's variable and fixed and come up with a contribution margin ratio, break even in units and dollars, a cost volume profit chart on your own paper. I'm not sure exactly about that. What is the break even sales? Yep, you'll need to pick the break even sales there in dollars. What's the expected margin of safety? Margin of safety is the extra you have beyond break even. That's what margin of safety is. It's the extra on top of the break even. And then finally, leverage. Leverage is calculated by the contribution margin divided by the operating income. Okay, so I'm going to keep going here. So let's see if I can. All right, so we want totals here. Thank you, guys.
Thank you.
I appreciate your patience with me. So, like I said, this is a new book and I'm still trying to make sure I know which one they're going to do. So.
Appreciate you.
You do.
Everything. Yeah.
Well, sometimes I don't feel as prepared as I should be, but
Yep.
here we are. Thank you,
Individually,
thank you.
so. Have a good weekend.
Have a good one. Okay, those of you on Zoom, you are welcome to bug out. Okay, I'm going to go ahead and finish this problem in my video, and then I'll go do a video on the very first problem, which was a high-low method. Okay, so I know you watched me do it, and maybe you don't need to watch it again, but I'm going to put it out there for anybody who didn't get a chance to. Okay, like I said, we're going to put together an income statement based on an estimate, right? Based on an estimate. So there's the expectation of the volume, 21,875. Okay, so we go down with that. And then this is the dollars per sales price per unit. Okay, and we're going to keep it at a whole dollar. And then we're going to bring in, okay, so we want direct materials. Hey, some of that's starting to come back into play. Direct materials, direct labor, manufacturing overhead. So however many units you're doing for sales, you're also going to use that for your variable costs, okay? But we're doing it the old way, and then we'll make a contribution margin income statement, okay? There is a difference. So let me go ahead and finish this out. If you need to leave, that's fine. You could come back in and go to the end of the video to find this. I appreciate your patience. Appreciate your patience. So I'll be honest with you, sometimes my brain doesn't work real good on the fly. I just sometimes like a chance to think about something first. So that's okay. We all kind of are wired differently. So there is my total in sales. Okay, and we want that in dollars. And I'm going to put that amount in just to see if I'm close. Okay, so let me get rid of this, make it a little bigger here, and check my work before I go any further. Yep, that's good. All right, so now each of these are going to be calculated by the number of units that we're selling. All right, so we got direct materials, direct labor, and manufacturing overhead. Okay, and they each have a value, an estimate. Okay, and we'll just bring this down. So we're going to use that same volume. Same volume. Oop, that's too many zeros. And now we're going to reference what the cost is, right? So the cost for direct materials is $46 a unit, $40 a unit, and $20 a unit. Now, our other fixed is manufacturing overhead has a fixed piece. All right, so we'll come back to that. And what happened to my dollars here, or my sales dollars? Okay, and then we can just bring this, nope, we can bring this down and we should get the formula to work. Yep. And we want all these to be dollars. Okay, so let's plug this in for our cost of goods sold, right? Which is your direct materials. Okay, so, and then direct labor, and you take the same amount of units that you sold times whatever the cost is for those. Okay, now we want to add those together. So we're going to do a total cost of goods sold. Cost of goods sold is always variable, right? Cost of goods sold, it's always variable. Well, okay, so we only want the three expenses there, not the sales too. It's right here is what I want added up. So there's the cost of goods sold, right? 2,318,750. Now we're going to subtract. So here comes gross profit. Okay, gross profit. Okay, now I'm going to take sales minus cost of goods sold. Okay, so this is our gross profit. And I'm going to put a line underneath. And, okay, so, and once again, this is sales minus cost of goods sold. Sales less cost of goods sold. Yep. All right. So here is the gross profit, 1,181,250. Now we're ready for the selling expenses. Selling expenses, notice there is a fixed piece and a variable piece, right? Yep. So let's just put in what they say right here, because we're doing this. And then if we have a sales salary and commission, we will do both of those. All right. So here comes selling. And okay. So selling, if we were doing it the old way of doing our income statement. Okay. All right. So this becomes sales salary. I'm just going to put salaries. That's good enough. Sales sal. Okay. Advertising, travel, and miscellaneous. Advertising, travel, and miscellaneous. Okay, Molly and Annie, I'm glad you could hang out with me. Oh, I got to put the word travel. Okay, and then miscellaneous. Okay, so be careful on this. income statement, we don't really care whether how things are broken up variably or fixed. Okay, but we do care about what is the cost of goods sold and then what's selling and what's admin. So we're going to have a total here. Okay, so total of our selling. Okay, so I'm going to put these in. Okay, 110,000 and 40,000, which is completely fixed. 12,000, which is fixed, and 6,700. All right, so now we're going to put the variable piece. So I'm going to put fixed here, and this is just for later. Okay, just for later. Okay. So then we'll put variable over here, and two of these vary, right? Two of these vary. So let's see. It says, here's the cost per unit sold. Well, we know how many units sold right here. So this variable piece is going to get added to this fixed piece. And so will miscellaneous. Okay, miscellaneous has 7,600 plus a variable amount of $1. Okay, the variable amount for oh, I see what I did. Hang on. Okay, this is the title of selling, right? I was up too far. 110,000, 40,000, 12,000, 7,600. And now and then this is $8 per unit sold. Okay, so we're going to get a total that gets added to this, right? And these are all dollars here. Okay, these are all dollars. Yeah, it's good to keep everything labeled correctly. All right, so then this variable piece, it's $8, and we're gonna take 8 times the number that we sold. Here's the units sold here. Okay, units sold. Hi, Molly. How are you doing? If you don't want to talk, that's okay. I need to focus anyway. All right, so there's our units sold. So this is also going to be part of the varied amount. So we're going to take the number we sold times 8. So there's an extra 175,000. So this is the variable rate. Okay, and then this is the variable total. A variable total. Okay. All right, so now we have another one to do, kind of like this. All right, so this one has miscellaneous. So we take the number that we sold times $1. All right, and yep, $21,875 in variable total goes with this fixed amount, right? You add this to the fix. Be sure to add this to your fix when we put it in to the income statement, okay? So I'm going to put my numbers over here, okay? I'm going to go add my fixed sales salaries plus that new 175,000, and this is going to be the amount we're going to put in on the income statement. You also might put here, and we're just going to make it equal whatever's here, right? If there's nothing here, then it's simply going to equal what's over here. All right, so these two don't have any variable costs, but the last one does. And so we need to add fixed plus variable. And there is your selling, okay? So when you put your selling in, you will get a total. Okay, let's see if I made it with those. All right, so I like to put a equal sign underneath. Make sure total selling. All right, so here we go. We're giving it a chance. Well, 4 items. It's going to be sales, salary, and commissions, advertising, miscellaneous, or nope, travel, and then miscellaneous. Miscellaneous, and this is miscellaneous selling. If I key in those amounts over there in that far right column. Okay. Okay, we're just keying in what we put in the spreadsheet. All right, so 366, 475. Let's see if we're on track or not. Okay. Oop, I put one too many zeros. So one too many zeros, it happens. Most of us aren't used to putting 3 zeros after everything we do, so it's okay. All right, so there's that. Uh-oh. Let me see what I did here. Go back to this. Okay, I hadn't checked it yet, I guess. So here are the direct materials, direct labor. What did that say? Manufacturing overhead. Manufacturing overhead is estimated. Oh, guess what? Guess what? There's 2 features to that. Yep. So you got to add it to this. This is the variable piece. I'm sorry, I missed that. So what I'm going to do is I'm going to put the fixed amount right here to the side of my manufacturing overhead. Let's key that amount in, okay? Because we're not breaking it up variable and fixed right now, but we will. Okay, and so this amount needs to be added to this in order to get the number. Okay, so hang on a minute. Equals, okay, I'm going to put this in parentheses, 21,875 units sold times $20, close parentheses, plus the 200,000 that we just put in as fixed. And there we have it. So manufacturer's overhead should be different. It's up 200,000. See ya. All right. All right. So we're looking at 637,500. Okay. That makes things different. So then cost of goods sold. Yep. Is 981,250, which makes gross. This is gross profit. That's gross profit. Make sure you're following along the way you should. Try not to let me distract you. All right. So here is the amount of cost of goods sold. Okay. And so when we subtract that from our 3.5 million, we get gross profit of 981,250. Let's see if we got that right. I think so. Okay, I think we're back on track now. All right, we're ready for admin now. Okay, ready for admin. Admin. Okay, so then let's go see if any of our admin have any. Yeah, there are some that have a variable part to it. So let's put office salary. That is fixed. So I'm going to go all the way. I'll put the fixed here. Okay, I'm going to put the fixed here. The fixed part is 132,000. And then we don't have any as a variable rate. Okay, so the salaries are fixed only. Oops, wrong direction. Okay, and then we want a total over here to put in for that. So it's just gonna match that. Now we're gonna look at supplies. Supplies has a mixture, right? So put the fixed down first. And it's gonna have $4 per unit sold, okay? So let's keep doing the math here. Okay, and so the variable total is 21,875 times that rate is right there, okay? And then you're gonna add these two numbers together. Add them together, 10,000 plus the total variable, there it is. So it looks like it's 97,500, and then finally miscellaneous. So I'm just gonna abbreviate. Okay, and it has two pieces to it. There's a fixed piece and then a variable piece. So we want all of this to be dollars. Clear over to here. Okay, and then we're just gonna use that same, so we have number of units sold times $1. Yeah, you could key it in, but don't. Make Excel do a little math for you, okay? Now I should be able to bring this formula down because this formula says take this amount plus this amount. You can just drag it and it'll do that. I didn't drag it for this one because, yeah, I could. It's got, because it doesn't have anything here. Okay, the fact that they don't have anything here shows you could drag it. So let's say, for just example, that you knew how to do this one, but you didn't want to have to do a formula again or make it equal something. You should be able to just, well, nope. Okay, that's fine. So we're just going to say equals. Equals is good enough. Yeah. Okay. So now let's put this stuff in where it goes. So admin has salaries for the office, and then they have supplies, and then we have miscellaneous. Make sure you pick miscellaneous administrative expenses. Now we're going to key in what we found on the right side. This right here. 132,000, 97,500, and 35,275. We're going to add those together to get a total. So here we go. Whoop. That total. Okay, I got 264,775. 264,775. Now we want total expenses. Total expenses are these two added together, right? So let's do this. Total expenses. Okay, we're going to use these two totals right here. So the total for selling plus the total for admin. I got 631,250. Okay, now here comes the real magic. So now we got to remember, by the way, your sales is up here. I'm going to move the sales over here. Okay, the sales is 21,875 times whatever your sales price says. Okay, so that is the 3.5 million. It's okay, I can bring that over. So these are the total expenses. Okay, and this gets calculated from, let's not forget, this gets calculated from this number. Okay, so, or here's the gross profit, yeah. So gross profit is over here. I'm just gonna make it equal here. Gross profit, and we're going to subtract this from the gross profit. Now that we have found all the expense amounts. Okay, so I'll just take this one out, and now I'm gonna subtract, and this is gonna be net operating income. Okay, so I'm gonna put net or operating income's fine. What do they have it? Operating income. Okay, operating income. And that's simply your gross profit. Remember, gross profit is a subtotal minus the operating expenses. So I got $350,000 in operating income. So the reason they're having us do the old-fashioned way to do it is when we do this one, we better end up with the same number, because each income statement should have the end result on it of whatever it is, whatever, that shouldn't change based on whether you're doing an income statement, formal income statement, or contribution income statement. Okay, so let's go ahead and kind of make one here for, and we don't have a template. Okay, so all we know is this is what it needs to equal. And let me just double check that I got the right number. Okay, that's good. Okay, let's see. So now what's the expected contribution margin ratio? Okay, so now what we're going to do is take our sales, right? Which is 3.5 million. Here it is by the unit. Here, these are by the unit. Okay, so let's start fleshing this out. Okay, let's put sales. Okay, so we know how much units we use, 21,000. Okay, so I'm actually going to put units sold here. All right, units sold. 21,875. That doesn't change. Okay, and this is units sold. Okay, now we're going to put some figures in here. So sales, and it has a per unit, okay, per unit, sales price per unit is $160. Okay, so we're going to put that in. And then we know how much the cost of goods sold is. Yep, you add these three up, and that's how much the cost of goods sold is. We'll get to that here in a minute. So we're trying to find the contribution margin ratio. Okay, so let's see, let's get started. So sales, okay, and we've got 21,875. Okay, this is per unit. We're going to have a per unit. Actually, I'm going to move this over. Okay, let's do per unit. Okay, this can be a sales price or cost. So units sold, 21,875. So $160 is the sale, right? And then we can actually look at the total in this column. So 21,875 times $160. Okay, so 3,500,000. Yep, that's right. Let's put this in and put $sign with it. Yep. We got to take off 2 decimals, I think. Come on. There we go. Okay, now we're gonna do variable costs, So we've got to come up with how much they are per unit, okay? So what we can do is take direct materials, direct labor, manufacturing overhead. And when we do manufacturing overhead, we only want the per unit stuff. When we do these, we'll just use these per unit stuff, okay? So let's come up with variable cost per unit. Okay, all the variable costs that go in. This is the sales price per unit. Okay, so now comes variable costs. And we're going to put these in per unit. Okay, so we're looking at 46, 40, and 20. Okay. 46, 40, and 20. Okay. And then you can label these direct materials, direct labor, and then this is manufacturing overhead, just the variable piece. Okay, we'll be sure to add that to the fixed when we get down to it. Okay, another variable that we need to account for is 8 and 1 and 4 and 1. All right, so we're going to put sales salaries. It has a piece to it that they told us what it is. So I think it's 8. Okay, so let me just double check. Yes. And we'll have a total. So we take that times. So sales salary variable piece has you take that number times the number we're selling. How many are we selling? 21,875. So let's go ahead and put these other 3 in. So this is miscellaneous selling. Okay, and it goes on at $1 per unit sold. Now we're ready for administrative. So then we're going to do supplies. Supplies has an amount of 10 and 4. So the variable part is the 4. And then finally, miscellaneous for admin. Say this is miscellaneous A. Okay, and this is miscellaneous selling. So, okay, so let's put these in. Okay, so then A is 1. So we should have, and count them, 1, 2, 3, 4, 5, 6, 7. We should have 7 variable costs. 1, 2, 3, 4, 5, 6, 7. Good. Let's calculate this. This is also per unit. Total variable cost per unit. Total variable cost per unit. Okay, so we're going to add these up and put it in. So it's 120. Okay, so we're going to start using that. Okay, so now we know what the variable cost, we can actually calculate the contribution margin. Yep, but I now want to start the fixed. Okay, I'm going to start the fixed. So contribution margin, let's think of the contribution margin as that gross profit. Okay, contribution margin. Because we got to find the percentage. All right. So what percentage is variable costs of sales, right? What is its percentage? So I should do this. Hang on. I should put all those over here, right? And put the totals then down there so you know that we're actually going to deal with here. So those are all the variable costs, but we don't want it to add that. We want it to be here. There we go. Okay, it's not supposed to be up there. It's supposed to be over here, -1. There we go. Oh, go ahead. Nope. There we go. Whoop. Nope. That is supposed to be over there. It's the sales amount that's not supposed to be there. My fault. Okay, let's try this one more time. And I left out that one too. Good grief. All right, be careful. Make sure if you're using formulas that you're getting everything that you thought you had. Okay. Yes. Okay. Nope. Just a second. It's trying to be too helpful. Sometimes it can be too helpful. We want a sum, so equals sum, open parentheses, click and drag from here to here, close parentheses, and enter. There we go. So these are the variable costs, and now let's get the percentages of the variable cost and the contribution margin. So if you subtract 120 from 160, you get a contribution margin per unit. Contribution margin per unit. Be sure to put that in. So you remember. Now we're going to be able to figure out the percentages. So we take whatever's here and divide by sales. Okay, and same for this one. Whatever is the contribution margin divided by the sales. Okay, and we don't want them in dollars. We want them in percentages, or decimals is okay. Come on. There we go. Okay, so what does this mean? This means for every dollar that we sell, 25% of every dollar is making it past the variable costs. Okay, making it past the variable costs. By the way, the maximum sales within the relevant range are 27,000 units. So if this was making more than that, we might have to go back and ask them if their fixed assets need to be adjusted. All right, so now we can find the contribution margin. That's what this is. It's the ratio. Okay, I just found the ratio. If they want the contribution margin per unit, it's this number. Okay. And I want to put dollars where dollars go. And one more time, this is the contribution margin ratio, CM ratio. So sometimes it's hard to remember that. So let's put 25% here and see if we're on the right track. Looks like we are. Now we're ready for break even. Okay, break even. So let's go back to our break even. They want it in units and sales dollars. So let's do break even in units. And we need to come up with, hang on a minute, we need to finish this. Okay, we need to finish this. So we're going to do our fixed costs. Okay, we're going to do our fixed costs before they get away from us. So this will be fixed costs. We need to accumulate them. And guess what? When it's all over with, we should have a total here. And so what I'm going to do, just for kicks, is this had 160,000. I'm going to do totals here. Okay, so totals here, I guess. That's fine. One more time. The number we're selling times the rate. And if we want this number to hold still, we'll put dollar signs in front of the letter and the number of the cell. Enter. Okay, so now we may have to do it again. So that's all right. Let me move this. Here is the formula. This is this number, so this is making it hold still times D 197. So we can take that formula. And now these are going to be costs. Okay, be careful. So we can drag this formula down just to the first one. Okay, just to the first one, and then we'll fix it so that it reads correctly. So we're looking at, and we want B, okay, divided by D 200 times D 200. D 200. Oh, okay, so that should be C 200. Okay, so there is the total of the direct materials, right? Okay, now let's see if I pull this down. Nope. Nope. Gotta wait for that black plus sign. Let's see if we got it. Okay, and then these are all the fixed. Okay, it's all fixed. Here's your total fixed. I'm going to put the total fixed out here to the side. Total fixed. Okay, so we want all of these right here for fixed. I got 2,625,000, right? So back to break even, right? Back to break even in units. Just to remind you, break even in units is your fixed, total fixed costs. Okay, and that amount we just found right there. So I'm going to make that equal that. And then we want units. If we want units, we're going to divide by the contribution margin per unit. Okay, so contribution margin per unit equals $40. Okay. And then here is the formula. Total fixed costs divided by contribution margin. Okay, so here we go. Total fixed costs divided by CM. Okay. Because you have to have enough contribution margin to cover the fixed expenses. Okay. So let me put the number in. Okay, I didn't put it in right, obviously. Okay, we're going to divide. Sorry, we're going to divide. So 2,625,000 divided by 40. There we go. There's the total units. Now, this is not dollars. This is units. This is break-even sales units. Break-even sales units. Okay, so be careful what you find. Make sure you can explain it. Okay. All right, so take it down. Whoops. So let's see if I'm right. Okay. Okay, I got 65,625. Okay. I'll be back to see what's up. Just a minute. Okay, we are back with the last problem in Chapter 6's coursework. And then I'm also going to add on to this the first problem. Okay, so you can see that if you need it. So we are in the big problem where we're supposed to come up with contribution margin, break-even sales, cost, volume, profit, chart, which you don't have to do a chart, margin of safety, and operating leverage. This is all estimated information. Notice some costs are completely variable, some are completely fixed, and some are mixed. Okay, so when you add it all up, here is the total of the fixed, right? And I got mine to agree too. And there is the total of the variable cost per unit. We are selling 221,875 units at a price of 160, and the maximum sales was within the relevant range are 27,000 units. So we wouldn't want to go beyond that because that might change some things. All right, so we're needing to put together a regular income statement. This does not separate out the variable or the fixed, right? This is just like what we used to do. So we have sales. So you would take your number of units sold times your sales price. And then all those units that you sell, we're going to come up with, right? We've got direct materials. So I've got sales. Here's the number of units. Here's the sales. Okay, so I want to make sure you can see where these numbers are coming from. Yes, right here. So then same amount of sales times 46 in direct materials, 40 in direct labor, 20 in manufacturing overhead. And here's the math. Okay, that's how much gets spent. Okay, so the cost of goods sold in total is 2,518,750. We subtract that from sales, we get gross profit. Now you have to start listing expenses. Now, sales, salary and commission, advertising. Now be careful, sales, salary and commission is mixed. So you have a fixed amount of 110,000 plus this is the rate times the sales volume. Okay, rate times sales volume. Put times sales times unit sales. Sales volume. Okay. All right. So this is the variable total. So then these two get added together. For 285,000, advertisement is one fixed. Travel is one fixed amount. Miscellaneous is 7,600 plus a variable amount of $1 per unit sold. Okay. So when you add up all the selling, here is 36,36647. Okay, now we're ready to go to admin. So admin has office salaries that are completely fixed. And then supplies starts with a fixed amount of 10 grand. Okay, and has a variable piece, sales times $4. And there's where we're getting 87,500. And then we add the fixed and the variable together and report it. And miscellaneous has a fixed amount of 13,400, a variable amount of 1 times the number of units sold and added together. These two get added together. Don't forget to do that. So 264,775 total expenses. Total expenses from the gross profit is 350. Okay, 350. Okay, let me show you. Okay, that's the admin cost total. Let me go over here. Here we go. Here's all expenses, right? That's both of those. And then all these expenses get subtracted from the gross profit. So we had operating network of $350,000. Okay, now we're going to throw it in to what we're learning about the contribution margin. All right, so we are going to have to separate things out. So we'll still use the same number of sales. Now let's look at our variable costs. So direct materials, direct labor. And I went ahead and put the amount per unit and then the total. And all of this is going to be times the units sold. Okay, yes, I know it's $120 per, that's variable cost per unit. That leaves $40 for contribution margin. Okay, this is 75% of the sales price, and that means contribution margin ratio is 25%. So 25% is the contribution margin ratio. If that said the unit contribution margin, then you would use 160 minus 120, you would use 40. So if they ask for the ratio, they want the percentage. If they ask for the unit contribution margin, they want the dollars per unit. Okay, so then we need to do a break even. Okay, break even. Break even is when your contribution margin equals your fixed costs, right? Fixed costs. So here we go. So here is your fixed costs. You added up all your fixed, and they have that here as well. 525,000. So I'm glad I came up with that. All right. And then we're going to divide the first one by the $40 unit contribution margin. That gives us the number of units to break even, which is 13,125. Okay, 13,125. There's two ways you can find your sales dollars. If you know how much they're selling the items for, which we have to, we're going to take this break-even units times 160, and it gets to 2,100,000. Okay, that is the break-even in sales dollars. The other way that you can do it is to take fixed costs, divide by the CM ratio, which is 25%. And when you do that, okay, let me change this. It should be 25%. When you do that by 25%, make sure I'm doing the math right here. Yep. Okay. 20 divided by 25% gives us sales dollars. Oh, it's the same number. Yep. So 2,100,000 is the sales, break-even sales. Okay, break-even sales. And it doesn't matter which one you get to. Sometimes you don't get all the pieces to do it one way. You have to kind of see what you have. All right, the next one is to do a cost volume profit chart on your own. Don't worry about that. It just is going to show the fixed costs and break even. All right, so, and one more time, it's the same amount, 2,100,000. What is the expected margin of safety in dollars and a percent of sales? Okay, so let me change this, percent of sales. All right, we've got two things to find. All right, and here's how you find the margin of safety in dollars. You take your sales, which my sales are 3.5 million, minus my break-even sales. My break-even sales are 2,100,000. You just subtract it, right? You just subtract it, and then you have your margin of safety in dollars right here. So it's 1,400,000. Now, if you want that as a percent of sales, then you take that value that you just found and divide by the sales amount of 3.5 million. You're going to find out that you have a margin of safety of 40%. So that means that if sales went down, we have a cushion of 40%. We have a cushion of 40%. Margin of safety is a cushion before you get to break even. Okay, because at anything below break even, you're at a loss. Okay, you're at a loss. All right, the last one is this operating leverage, and I think this is kind of cool. Operating leverage, it's calculated by total contribution margin dollars divided by operating income dollars. Okay, so let me put this dollar sign here. And so 875,000 is my dollars in contribution margin. Here it is. Back to it. We got 3.5 million and 2,625,000 in variable cost. And then total contribution margin is left over after we subtract the variable costs, 875. So we start with 875 and we divide it by the operating income, which we found right here. This was at the bottom of our original income statement. Okay, so we're going to use that value. Okay, and here is the math. 875,000 divided by 350,000 gives you a leverage of 2.5. And you say, what does that mean? What does that leverage mean? Well, what this means is for every increase and decrease in sales, that change is amplified by 2.5 times. So for example, if you had an increase in sales of $100,000, you take the $100,000 times 2.5, and if all else stays the same, you'll actually increase your operating income 2.5 times. Now, the opposite is true. What if this was a loss, right? If it's a loss, then unfortunately, we're going to lose that much in operating income too. So leverage amplifies some increase or decrease in sales. All right. I'm going to go back up to the first one because I forgot to record. All right. So this is another high-low method. High-low method. Right. So let me throw this in here. I don't even know if this is the same one. I think it is. So remember, total cost equals fixed cost plus variable cost. You can isolate fixed costs when you take total cost minus variable cost. You can also separate or isolate variable costs equals total cost minus fixed costs. So we have activity here. So I've put this activity in, and then I've also put in its corresponding cost. And when you pick the highest activity, don't look at the cost, just go pick. There's the highest, and that's the number that goes with it. There's the lowest, and that's the number that goes with it. So then, once you've picked it, pick the high, and it goes in as a positive number. Pick the low activity, the dollar costs, and the units produced, and we're going to subtract, okay? Subtract low from high. We're going to calculate the difference. So this is the dollar value of costs between a high activity and a low activity. And then this is the units produced beyond units produced when you compare high to low. All right. So what we're going to do then is the second step is to use these numbers right here to find our variable cost per unit. Okay. So I've got 28,600 in calculate the difference. That's by subtracting the low amount of cost from the high amount of cost and the low amount of activity from the high amount of activity. And when you have these two numbers, then you keep dividing. So 28,600 divided by 1,300 is $22 for variable costs. Okay, so that's the first thing they want. So there's the variable cost per unit. Now we're going to find the total fixed cost. So that's step 3. Okay, so we want fixed cost equals total cost minus our newest part of the cost formula we just found, variable cost is 22. So there's the variable cost times the highest volume, okay? So this is the fixed cost, and then the variable cost we solved for, take that times the units produced, okay? So then you add these two together and you get, no, you don't. You take total costs and subtract the variable cost, okay? Be sure that you do that. Don't forget what these are. Okay, so I'm gonna make this go down one. Yeah, okay, well, okay. So just remember, this is total cost minus variable cost, total variable cost. That's what's happening here, and that's how we found our fixed cost. So once we know what our variable cost is and what we know our fixed cost, we're going to set it up as a formula. For our total cost, even though they're not asking for that, the formula is total cost equals 37,180 in fixed costs plus $22 times the number of units. Okay, so you're going to get a fixed piece and a variable piece. And when they add together, okay, then that should be the total cost. So we found the two things we needed, and there's the fixed, and there is the amount we calculated when we take 22 times 940. And when you add them together, total cost for 940 units. Be careful to look for that. See, up here, we were doing 1950, but now they're asking us with 940 units. Okay, 940 units. Yep, so what's nice about these cost formula or cost equations is you can stick in the number of units as long as it's within relevant range, then you can find the total cost. So the total cost ended up being 57,860. Okay, I think that's all for now. And I am going to say goodbye and move on to a couple of other videos. Thank you very much. I'll stop my share. Have a good weekend, the rest of your week. And the spring countdown begins. All right. Very good. I'm gonna that. Hmm. there. Mhm. Hmm.